The stock market is about to do something completely crazy, and there's nothing much that can be done about it. An index called the MOVE Index is coming down from levels not seen since 2009. The MOVE Index measures the volatility of interest rates, and this downtrend that you see here is going to lead to a huge opportunity over the next few months that few people are paying attention to. This MOVE Index is basically the volatility of the bond market, so it shows us how volatile interest rates are. The higher the MOVE Index is, the more uncertainty around interest rates there is, and the lower it is, the more stable the interest rate environment is. High interest rate stability is something that we saw in 2002, during the financial crisis in 2009, and in 2020. All three of these moments happen to coincide with large drops on the stock market, with the peaks in interest rate stability coinciding almost perfectly with the bottoms in the stock market. But in all three of these cases, when interest rates stabilized, it led to the three most incredible stock market rallies of the last 20 years. This is something that we've been repeating since late 2023, that stabilizing interest rates would be a great thing for the stock market. And today, the fact of the matter is that interest rate volatility could continue to decline to the same levels where we were before the pandemic, which could continue to push the market even higher. In this video, I'm going to show you why this is actually a pretty likely outcome for the stock market over the next few months, but also show you the risks that exist to this thesis. Because today, the biggest risk to the stock market is actually that this black line that you see here begins to rise. Rising interest rate volatility is something we saw throughout the bear market in 2022. It's something we saw during the bear market in 2020, and of course during the financial crisis. There's two things that could cause that to happen. Interest rate volatility can either rise because there's lots of concerns around growth, or they can rise because there's lots of concerns around inflation. Let's first take a look at the growth component. Between 2007 and 2009, the main reason why interest rate volatility was rising was because the US economy was weakening substantially. We've added US jobless claims on this chart, and you can see that as people were losing their jobs in 2008, that caused interest rate volatility to rise. The high levels of unemployment in 2001 and 2002 was also the key reason why interest rate volatility was so elevated in 2002. Right now, as you can see from this chart, this is not at all a concern. Initial jobless claims have stayed very low throughout 2023 and 2024, which is one of the key reasons why interest rate volatility has been able to come back down to normal levels after spiking in 2022. You can see low levels of unemployment between 2016 and 2019 kept interest rate volatility quite low during this period. Now, as we've highlighted in many of our recent videos, we do think that at some point over the next year, we're going to start to see initial jobless claims arise like they did in 2007 and 2008. But for now, these low levels of unemployment are a magnet for interest rate volatility to come back down, and for that to push the market higher. Now, as you can see from this part of the chart here, interest rate volatility can rise without initial jobless claims rising. In fact, in 2022, initial jobless claim was falling quite aggressively while interest rate volatility rose substantially. And this takes us to the second reason why interest rate volatility can rise, and that is rising inflation concerns. You can see if we zoom in on this part of the MOVE Index, we can see that interest rate volatility has been highly correlated to the price of oil. And you can see since about June of 2022, we've seen oil prices trend lower and cause interest rate volatility to come back down to more reasonable levels. If oil prices continue to stabilize or even trend lower over the next few months, which is for now our expectation, you could see the MOVE Index move substantially lower, triggering yet another melt up in the stock market. But as we've said over the last few months, if oil begins to break out, you're going to see interest rate volatility rise again and bring the stock market lower. This is not our base case, but if it happens, we'll be booking profits on our trades on our website and cutting down our stock market exposure significantly. Adapting to changing circumstances and changing data is a cornerstone to become successful in financial markets. We've had this thesis of stabilizing interest rate since November of 2023, and we doubled down on it in April of this year, not because we have a crystal ball, but because in both of these instances, oil was trending lower, telling us the market could move higher. And this remains the most powerful dynamic that exists in financial markets today. And the purpose of this video is to tell you that if oil prices continue to move lower, you're going to see stock market prices continue to move higher over the next few months. But are stocks today not already way too expensive to actually continue on moving higher? Because after all, stock market valuations, as we highlight in many of our videos, are currently at historic levels, the same level of valuations to what we saw at the peak of the market in 1929 and at the heart of the dot-com bubble in 1999. Well, if we zoom in on this part of the chart and we add the MOVE index again, but this time we flip it around, you can see the MOVE index is a mirror image of stock market valuations. So the truth of the matter is that if interest rates continue to stabilize over the next few months, we could see the stock market reach even more insane valuations. Now, when the MOVE index finally turns around, which we think is going to be triggered by a recession, that's when stock market valuations could actually start to decline very significantly, and in our opinion, possibly lead the market down by 40 to 50%. That's why the title of this video is that stocks are about to go crazy, because you've got a bullish setup on the market right now. That's why stocks are rising. But from a macro and valuation standpoint, it happens to be, in our opinion, one of the most risky moments in financial market history since 1929. Our goal is to take as many people through this journey as successfully as possible. If you want to join along, consider giving our service a try.